This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, at the end of the American dream looms as the unthinkable draws near. And while many American families can handle a financial shock or even a recession, there's one thing they can't handle. I'm going to show you what it is and why. It's coming soon. And is the U.S. housing market on the brink of an outright collapse alongside the U.S. economy, which many say is now seeing a second revival or has experienced a soft landing? We're going to make the case of why that's coming to an end. And the U.S. labor market that everyone says is strong and robust, we're going to make the case of why it is about to see a big surge in unemployment claims. And if you're wondering what we're doing out in Cushing, Oklahoma today, well, the oil markets are giving us some critical information on the future path of the U.S. economy. And we have a sponsor for today's show, Volition RX. They're on the New York Stock Exchange under the symbol VNRX. They've got a breakthrough cancer detection method, and we think this is going to be a catalyst to send their stock up by as much as 64%. We're going to show you just how to trade it, and if you love technical analysis and Elliott wave theory, stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with the headline: oil drops as bearish trends counter the Middle East conflict's risk. And you may remember in weeks past, we showed you all these headlines about how oil was going to hit 100 a barrel and then 150. And in some cases, it was going to go to $200 a barrel because the conflict in the Middle East was going to send oil prices to the moon. And yet we made the case and we argued and said that, look, oil prices can see a shock due to a global conflict. But in the end of the day, they follow economic fundamentals. And sure enough, we're starting to see those signs now. As beyond the Middle East, U.S. stockpiles rose by 1.37 million barrels last week, this according to the Energy Information Administration, or EIA. Inventories at Cushing, Oklahoma, where we're at today, the storage hub expanded by 213,000 barrels, as physical oil markets across the world are also seeing a slump in prices as profits from making fuel such as gasoline dip ahead of the winter season. So all of a sudden you see this change in narrative that we saw, during the initial outbreak of the conflict was that, hey, oil prices are going higher, and now it's shifting to, well, demand is going to head down. So the question is, which one's right? Well, it has everything to do with economic fundamentals. In the end of the day, you can get a short-term move in the oil markets and the gasoline markets due to conflicts, but in the end of the day, it's all about the economy. And here we can see that evidence as we take a look at the general business activity, this for the Philly Fed in the manufacturing sector against crude oil prices. That's shown in red on dollars per barrel. I almost said year-over-year rate of change, but we don't have it in this chart because here's what I want you to see. The manufacturing sector, the blue line, when it goes below the black line, the horizontal black line, that is where you see the manufacturing sector contract. Here you can see in the global financial crisis, the manufacturing sector was contracting, oil prices surged higher, and then they came crashing down. Of course, we see that here during the dot-com bubble. Again, manufacturing slowdown, oil prices head down. You see that going into, of course, what was looking like a global recession, except this time oil prices led the manufacturing sector. Of course, we know they also led going into the pandemic, that slowdown. But how about now? We see this big surge high in oil prices that everyone says was going to 100 or maybe 200 a barrel. Who knows? Because of the conflict. And we said, no, wait a minute. That could happen in the short term, but watch economic fundamentals, because as oil prices go higher, I want you to be thinking of this from the American consumer's perspective. You've got rent, you've got food, and you've got energy, and you've got inflation. So you have a problem is your wages aren't keeping up, and we know that. And so if energy prices go higher, well, what does that mean? Of course, you can't drop your rent, you can't cut your food spending too much, but you do cut your discretionary spending, and of course, you cut how much you travel. That's why we're seeing oil prices turn around here, despite all those other headlines. And now let's take a look at the U.S. pending home sales, because the index is still near its record low. And what we're kind of setting up here is this broad story that the U.S. economy just saw a soft landing, and it's getting ready to surge higher. And we want you to see what really really the data is suggesting, because that's not going to happen. And then when we get to our lead story and you see that the unthinkable will impact American households, it's going to be one of the worst things that could happen that nobody, absolutely nobody, is prepared for. And here we can see the contract signings rose a whopping 1.1%. That's a huge monthly move in September. And sales improved in most regions. And here, despite the slight gain, pending contracts remain at historically low levels due to the highest mortgage rates in 20 years. And furthermore, inventory remains tight, which hinders sales but keeps home prices elevated. And this is a simple case. People want to move, but they don't want to take on a mortgage at a significantly higher interest rate. So this causes them to stay put, and that means inventory stay tight. But the problem is for new buyers, they can't get in either. The figures show the market for existing home sales continues to struggle to find its footing. A surge in mortgage rates to around a whopping 8% is making it more difficult to finance home purchases. Well, it's not making it difficult. It means people can't afford it. You see, it doesn't matter how high rates are. It matters that people have the income to afford it. We know they don't. That's the real issue here. It's not about rates. Moreover, many homeowners who locked in much lower borrowing costs in the past are hesitant to list their homes, suppressing inventory and keeping asking prices elevated, suggesting that if demand goes away, it's only a matter of time before the U.S. housing market comes tumbling down. But there's also these other effects. You think if people aren't buying, the builders aren't going to build as much. They're not going to hire as much. You don't need as many mortgage people, as many real estate people. You don't need all of the people that service that industry. And of course, that means we see a slowdown in the U.S. economy. But in the third quarter, it boomed. As the U.S. economy grew at a whopping 4.9% pace last quarter, the fastest since 2021, led by consumer spending, which jumped at a 4% rate, the most since 2021. And look at this core PCE, or personal consumption expenditures. The price index increased at less than forecast, 2.4%, suggesting consumers just came out and spent lights out. But what else changed is inflation cooled off. And that's one thing that not many people expected. But let's take a look at this, because we're making the case. I wanted to see what the oil markets were telling us. I wanted to see what the housing markets are telling us, because what it suggests for the fourth quarter, and wait till we get to the labor data, we've got that coming too, it all suggests the U.S. economy is slowing down. And then, of course, that puts us back to what the unthinkable is in our lead story. As the world's largest economy has remained steadfast in the face of high prices and a rapid run-up in borrowing costs, repeatedly outshining forecasters' expectations and tempering recession fears. The primary driver of that resilience is the enduring strength of the job market, which it is not. That is not what the case is. I'm going to show you what it is. Look, the labor market is good. Don't get me wrong. That is good. But that is not what's driving all of this spending at all. They've got it completely wrong, which continues to fuel household demand. Nope, that is not the case at all. My friends, it has everything to do with the fact that consumers in the U.S. borrow money they don't have to spend on things they don't need. And as long as they have access to credit, it is a debt-based economy. So if people are taking on debt and outspending it, that's what drives the economy way up really fast. Here you can see it. They've got it all wrong. They say it's a labor market, but no, it's not. Here you have real gross domestic product in blue against revolving consumer credit, owned and securitized, that in red, both on a year-over-year rate of change. And look what happened. We saw this big surge in the year-over-year rate of change of revolving credit. We saw in the data that people were tapping out their credit cards in a big way to keep up with inflation. And sure enough, that ended up driving real GDP higher. That's the real story here. The only question that we should be asking is when this will come to an end. It's simple. When banks say they've had enough and stop extending credit to consumers, and they hit that wall, max out those cards, and they max out all their line of credits, that's when this whole thing comes to an end. And that's how we know the third quarter here was all about credit. It has not anything to do with the jobs market. And looking ahead, the durability of economic momentum in the fourth quarter will help Federal Reserve officials determine whether to raise interest rates again, as many economists expect growth to slow in the final months of the year as borrowing costs, there we go, they're talking about interest rates, but it's not just about interest rates, limit the purchases of big-ticket items and student loan payments resume. Of course, what did we hear from the Federal Reserve? that the student loan repayments, they didn't see it having any effect on the economy. Absolutely, virtually none. And we know that's not the case at all. There's going to be a ton of households that are directly impacted by that. But let's take a look at what's really driving GDP growth and is going to send it down is not the labor market. It has to do with credit, but there's another base factor here where we started the show. It's about the economy. And here we can see real GDP in blue, still on a year-over-year rate change. And now we've got the current general activity for the Philly Fed. This is the manufacturing sector. Of course, we love this data because we've got a ton of it going back to the 70s. And what you can see is where the manufacturing sector goes. You see that in red. It's real easy to see where the U.S. economy falls. We had this big surge up in GDP as the manufacturing sector rebounded, and now it's pulling back down, suggesting that it's all about the real economy here. And we told you, don't buy into the fact that we're seeing a soft landing. There's no case for it. It is just a matter of consumers tapping out their credit, spending the last of their pandemic money, and buying into the fact that you hear all these policymakers and politicians say, well, we're going to experience a soft landing, so go out and spend. And in some sense, this can work. You get enough spending, you really do get a soft landing. But the problem is, it's about to hit a wall, and we know all the reasons why. It has to do with the banks. And here we can see real GDP in blue, still on a year-over-year rate of change, now against the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. And here's what we can note is when banks are on net tightening standards, that's when this red line, now I didn't draw in the base line for it, but when it's rising up here, you can see GDP growth slows. It happens each and every time. And this time we're hearing just the opposite, that, well, we're going to slow a little bit. The reality is that is not the case at all, because there isn't enough money. You know, we talk about this on a regular basis, is you need enough new money created by the banks to do two important things. One, pay on all the debt, which it never does, but we need that. And two, to sustain growth. So if we don't have enough new money created to do both, then growth must come down because debt gets prioritized in our economy. But nevertheless, there still won't be enough money to pay on all of it, which is why we continue to see a rise in delinquencies that will lead to defaults. So there's no chance that this next fourth quarter in data is going to look anywhere close to as good as the third quarter, and that's going to put, as we know it, the Federal Reserve on ice. And so far, the data suggests inflation continues to dissipate, a case that we've been making. And I know many of you said, Steve, no, inflation, it's up, it's going to go higher, it's here to stay. We said, not a chance, no way. The closely watched core personal consumption expenditures price index, which strips out food and energy costs, stepped down to 2.4% pace in the third quarter. And including the more volatile categories, the overall PCE price index increased to 2.9. Again, both slowing down here. And at the same time, service sector inflation, including housing and energy, a narrow measure watched closely by Fed officials, rose at a 3.6% rate, a slight pickup from the prior quarter. And here's what we know about inflation. When you overlay the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, that's still shown in red against the consumer price index. That in blue on a year-over-year rate of change. What we know is banks can start tightening credit and inflation can still rise because money is still in the system. But as there's not enough new money created to sustain growth and pay on all the debt, what happens is growth takes a hit, inflation comes down as consumers have less money. You see it here in the dot-com bubble. You see it again during the global financial crisis. Yes, inflation surged until it turned into deflation. How about here? During 2015, 2016, banks briefly tightened lending standards as the global economy slowed. What happened to inflation? Cooled off a bit. Happened going into the pandemic. You see, just before that, we were headed to another global recession. Banks started tightening standards. Inflation came down. This time, banks can tighten any as much as they want, and inflation is going to surge. Not a case. That is not possible based on the design of our economy. And yet today, we get the U.S. durable goods new orders, and the numbers are light out, suggesting that maybe the U.S. economy is in far better shape than we make the case on the show, until you look under the covers and find out that one company, just one, skewed the whole data series. And here you can see U.S. durable goods orders soared in September, by the most in 3 years, and after 2 straight months of declines, preliminary durable goods for September sort of whopping 4.7% month over month. That's off the charts. And here you can see, I want you to make the case of what's going on here, because we go back to this Philly Fed data and look at, of course, the general business activity for the manufacturing sector, and we overlay new orders, that in red on a year-over-year rate of change. What should we be seeing here? Is new orders starting to come back down? Perhaps there's a lag in the data, or there's the Boeing effect, and this is the biggest month-over-month jump since July of 2020, as orders excluding transports rose 0.5%, and ex-defense soared at 5.8%. Defense spending tumbled 14.4%, but get this, non-defense aircraft, there's Boeing, spending soared 92.5%. There's the skew in the data. Now, what is coming for American households? First, let's start with the unemployment data. I want to look at that and then show you why the unthinkable is about to occur, and there's virtually nothing now that we can see that will stop it from happening, and most households couldn't handle it. As continuing jobless claims jump to the highest since May, here we see jobless benefits rose from 200,000 to 210, but still remain at or near record lows. And anytime you see, initial claims in the low 200,000, I mean, that is extremely low numbers. And we've made the case of why this is going to change. But one of the things we need to look at is that continued claims are ticking higher. That means people are staying on unemployment longer. They're having trouble finding a job. And where continued claims go, you can see it just briefly here in red, but you see continued claims rising. You can see it here again. That's where initial claims follow. So we know more layoffs are coming, despite the fact that what are we hearing from these surveys that they're going to hire? Well, they're not really. They're just saying they want to, but in reality, they're not. Here we can see back to that Philly Fed General Business Activity Index for the manufacturing sector there. And what do we know is when the blue part goes down below the black line, that's when the manufacturing sector in Philadelphia is in contraction. What do you see in continuing claims data? It tends to head higher. That's what we're seeing here. It's reverse direction. Continuing claims are up, telling us that all of that survey data that they're going to hire maybe isn't going to happen at all. If it doesn't, watch out. We'll see initial claims start to shoot higher. The U.S. economy starts to unwind, and then we get to the unthinkable scenario. Because I want you to understand, where have Americans put all of their money and savings? In the U.S. stock equity market. They don't believe stocks can go down. We see people from the rest of the world pile into U.S. equities, and now the unthinkable could face. They can handle recession. They can handle financial shock, but stocks coming down, that means, of course, net worths come down, and that means spending comes down, and it hits the economy in a big way. And yet, while no one believes it, we see big tech sheds $200 billion in value as earnings disappoint. We said this was going to happen, and let's take a look. As 7 companies have been the story of the year in the stock market, with a frenzy of interest around artificial intelligence and fueling the gains. But here we can see Metre's results. What happened there? They had a hopes for long-term advertising recovery, saying it was at the whim of a, quote, uncertain economic environment. How about we look at Alphabet or Google? Smaller than expected profit. The loss was the biggest single session market value wipeout for the search giant. And here is why everybody's piling to the U.S. equity market, thinking corporate profits are going higher. And we've told you, when you look at this from a money perspective, and the net percentage banks tightening standards for commercial industrial loans to firms of all sizes, what happens when there's not enough money to sustain growth? Profits come down. You see it here during the dot-com bubble. You see it during the global financial crisis. You see it during the pandemic briefly until all the borrowing took place. And now we're going to see it happen again. And when you overlay the Wilshire 5000 or total U.S. stock market, it suggests that no, we're not at the cusp of the next big bull market. We're at the cusp of what could be the next big bear market for equities. And this is going to impact households in a huge way because it drives so much spending. You go back down Greenspan, we talk about the wealth effect. And if this is the unthinkable that happens, if U.S. equity prices come down, there is nothing left that can save the U.S. economy. And households are completely unprepared for it because they're overweight U.S. stocks. They got out of the bond market, they got into equities. They're just not prepared for it. But one thing that we do think could save your trading account and your investments. Well, that's our sponsor for today's show, Volition RX. They're on the New York Stock Exchange under the symbol VNRX. Here's our website. Let's take a look. because they've got a breakthrough cancer detection method. We want to take a look at that, and I want to give you a chart set up here that you're going to be amazed. If you like technical analysis, you like Elliott wave theory, you like supply zones, I'm going to make the case of why their stock could move up as much as 64%. Let's take a look at what's going on with this company. All the stuff is in the description and pinned comment, because as I said, they've got a breakthrough cancer detection method, and their mission is to save lives and improve outcomes for millions of people and animals worldwide. I think we're going to see Volition's technology in labs all around the world. And here's the chart set up. Let's take a look at this lower supply zone. What do we know? The MACD coming off of their nice, beautiful bottom, and that is rising. We see momentum building. How about the RSI? It's at 47 and climbing. We can see what happened. Price got down to the supply zone. Buyers came in, took it up into the little higher supply zone. Sellers pulled back. There's your wave 1 on Elliott wave theory. Pull back. Wave 2, and if you know anything about it, third wave is the biggest wave, takes you up to the next supply zone up here. And that, my friends, is your 64% move on the stock. Let's take a little deeper look at who Volition is. They are a diagnostic company focused on epigenetic markers. They've got human and veterinary use cases through screening and monitoring. They believe their total addressable markets are significant, of greater than a whopping 70 billion. Of course, their near-term focus for this year and next is driving sales for their vet cancer screening and monitoring tests and doing clinical and regulatory product development for sepsis. But they've got this breakthrough liquid biopsy blood test method for early stage cancer detection, and this is a big deal. Let's check this out, because there's nothing like this on the market, and that's what makes Volition RX one of a great opportunity here, and we see for them under the symbol VNRX on the New York Stock Exchange. As liquid biopsy for ctDNA, circulating tumor chromosome fragments. But look, they said DNA is DNA. You can't separate out the bit you want, and that is one of the problems with these tests. The question is, what would happen if you could suddenly get the part out you want? Well, that's what they're looking at doing here. The liquid biopsy, again, for ctDNA, you need to physically separate some or all of the DNA as ctDNA. And if you could do that, which is what their technology is doing, then you can do a simple PCR test, just as simple as a COVID-19 test. If you can imagine, that will be in every lab around the world. And this is a case we're making for their stock to go up. And as we zoom in now to the 90-day chart, you see this beautiful bottoming here in the supply zone. Buyers stepped in. You see price gets up into the other supply zone where sellers are at. Sellers drive it back down. Buyers come in again. Sellers pull back. And notice this pulling back into this volume here. This is what you want to see. And then that sets the catalyst for that wave 3 on Elliott wave theory, up 64% into that upper supply zone. Let's take a look at the comparison between chip/PCR with traditional NGS/ctDNA assays, as traditional assays cost over $1,000. But look at Volition's. It's around $100. Can be automated at any hospital lab. And that's the case we're making, is this technology is going to be in everywhere. Turn around in 1 day or less if it's automated. No library preparation, no sequencing, no computers needed. And you get a simple plus or minus PCR answer, just like a COVID test. And that makes this a very exciting opportunity, we think, for your trading account. And here we can see, in summary, they have an exciting breakthrough method. They've got a number of firsts. There's significant clinical and commercial opportunity here, again, on the New York Stock Exchange under the symbol VNRX. And let's take a look, one last look at their stock now. We're on the 30-day chart. Look at this. There's your volume profile. So the stock got up into the sell zone, pulling back right to the volume profile, where you want to see it, setting up the catalyst for that final move higher, which we think, again, could send their stock up as much as 64%. But as always, with any of our sponsors, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.